So it turns out financial news algorithms still do not know how to read a corporate filing. Welcome to Earnings Unscripted. It is April 9th, 2026, and we are unpacking Q2 results for WD-40, ticker WDFC. And today is just a classic case of man versus machine, right, Meryl?
It really is. I mean, if you checked the automated feeds this morning, you probably thought WD-40 just drove off a cliff. The bots scraped a $1.32 earnings per share and flagged it as a massive miss. Except, well, they pulled last year's non-GAAP number by mistake.
Which is hilarious, but also a really good time to remind everyone that this is just an entertainment podcast and definitely not financial advice. So please, do not sue us or the algorithms if you make a bad trade. But getting back to the actual GAAP EPS, it was what, $1.50?
$1.50, that is a 17% sequential jump, and the top line hit $161.7 million. Up nearly 5% quarter over quarter. So the actual fundamental business is completely disconnected from that panic headline.
Right, which perfectly explains the completely manic stock tape. Pre-market was it was pure chaos. It spiked up to $228 before reality set in, then dropped, and then kind of slowly grinded back up during the regular session to close positive, roughly 1.3%. It seems like the market had to literally wait for the CFO to get on the call and clear up the hallucination.
Yeah, Sarah Heiser actually complained about it live on the call. But look, once you get past the headline drama, the actual mechanics of the quarter are fascinating. Operating income accelerated 13% to hit $26.3 million, and they are pulling that off while global oil prices are absolutely surging.
Oh, wow, right, because their flagship product, the multi-use spray, is basically just specialized petrochemicals in a blue can. So if crude oil spikes in the Middle East, their costs should explode almost immediately.
Right, they should, but gross margins only dipped a tiny fraction sequentially to 55.6%. They essentially avoided the supply shock entirely because of, honestly, some brilliant supply chain engineering and inventory loading.
Okay, yes, but the geographic segments looked a little weird underneath that. I noticed the Americas segment was practically flat, but Europe and the Middle East shut up almost 11%. That feels backward, given the logistics friction over there.
It does, and the wild part is they actually lost volume in the Middle East due to friction transitioning to a new distributor, but they offset it through a massive surge in their specialist tools category. Think of the core WD-40 as a Swiss Army knife. The specialist products are the hammer, heavy-duty degreasers, rust removers, and they are successfully selling that premium hardware across geographies to cover local gaps.
Okay, I love that framing. A premium hammer making up for a regional distribution glitch. Let us actually dig into how they're playing this defense, because I want to know more about those warehouses.
Right, so look at the balance sheet. They purposefully stuffed their inventory pipe right before things got bad in the Middle East. Sarah Heiser, the CFO, pointed out they have this built-in lag. There is typically a delay of, between 90 and 120 days before raw material costs hit their cost of goods sold.
So wait, that means the crude oil spikes we are seeing right now, they're just not feeling it yet? Like they bought themselves a 3-month force field?
Basically, yes. And Steve Brass, actually, he joked about this on the call. He said, and I'm quoting here, "That was either excellent strategic planning or good fortune, whichever way you look at it."
Okay, I appreciate the honesty. I mean, probably a little bit of both, right?
Probably. But it's not just, hoarding cans. The real story here is agility. They used to rely heavily on a single manufacturing partner over in Europe. But over the last 3 years, they completely restructured that. When geopolitical tension hit, they just activated multiple new partners. They pivoted production across borders within weeks. That is real operational resilience, not just bullet points on a slide deck.
It actually sounds like they treat their supply chain the way software companies treat servers, just routing around the damage.
Exactly. But, and here's the catch, you can only outrun oil prices for so long. Eventually, month 4 arrives. And management definitely knows this.
Right. Sorry, I was going to say, This totally explains the guidance change, does it not? That sort of stealth downgrade?
Yes, good catch. Top-line guidance is reaffirmed. They still expect between 630 and 655 million for the year. But on the bottom line, last quarter they said they were tracking toward the mid to high end of their margin ranges.
And now?
Now they're just aiming to fall, quote, within their respective guidance ranges. It's a subtle shift, but when they're modeling crude oil at $95 to $115 a barrel, they're essentially acknowledging that quarter four margins are going to take a hit.
Okay, so if raw material costs are absolutely going up by the end of the year, how do you protect profitability? Because I imagine there's a ceiling on what a mechanic will pay for a standard can of WD-40 before they just, buy a generic brand.
You do not hike the price of the standard can. You change the delivery mechanism. You sell them the smart straw.
The smart straw, right? Of course.
Seriously, it's brilliant value extraction. Brass noted that premiumized products now represent approximately 50% of WD-40 multi-use sales. 50%! It's the exact same chemical formula, same liquid, but they attach a permanent bendable straw or the easy reach nozzle. And suddenly you have a meaningfully higher average selling price.
Wow, that is actually so simple. You're basically selling convenience instead of chemistry, which protects your margin without alienating the guy who just wants the classic spray.
Right, it's a packaging moat. But they're also looking at the chemistry itself now. They're actually testing an 85% bio-based version over in Europe. If it works, Brass says it will fundamentally reduce their dependence on petroleum over the long haul.
Which is the ultimate insurance policy. Wow. So they're buying time with inventory, buffering margins with clever packaging, and then completely rethinking the formula as a long-term safety net. That's a ton of moving parts for what seems like a very simple business. So I guess the big question is, where does this actually leave them heading into the back half of the year?
It leaves them playing a very careful waiting game. Management did reaffirm the overall revenue guidance, so they are still targeting roughly 630 to 655 million for the year. But they actually, they quietly walked back their profit expectations.
Oh, right, because they finally have to model in those higher crude prices.
Precisely. They are baking in oil between $95 and $115 a barrel. So instead of tracking toward the mid to high end of their margin targets like they thought last quarter, they are now just hoping to land somewhere inside the range. It is a very polite downgrade.
A polite downgrade. I mean, they're basically bracing for impact. And actually, thinking about last quarter, we talked heavily about them trying to unload those legacy household cleaning brands. Do they still have that anchor tied around their ankle?
They do. The America's Home Care stuff. They have an investment banking partner shopping it around right now, but management literally said there is no assurance a deal actually gets done. It is just sitting there.
Which is tough. I mean, if they cannot sell it, it kind of dilutes that whole premiumization strategy we were just talking about.
Right. Keeping it artificially props up their guidance by about 12.5 million in top-line revenue, but it drags down focus. They clearly want to be a premium tool company, not a legacy detergent business.
So it really looks like they're betting the next few months entirely on execution. They bought this 90-day grace period with their supply chain, but now they have to see if the premium cans can outrun the rising cost of oil.
That is exactly the setup. The inventory defense was brilliant, but the clock is ticking.
Well, they definitely know how to keep things interesting. I think that covers the blue and yellow can for today.
We will see if the margins are still squeaking by next quarter.
Wow, okay. Ending on a hardware pun. Goodbye, everyone. Just a quick note before we sign off. If you want these earnings breakdowns to just kind of naturally show up in your feed, definitely give the show a follow. And as an aside, this entire podcast is generated with the help of AI, which is exactly how we can process those giant, dense financial tables so quickly after the actual release. If there is a ticker you want us to dig into next, just shoot us an email at earningsunscripted@datamadness.ca or grab the X link in the show notes to say hi.
Catch you next time.